The closing bell has rung. Welcome back to the deep dive. This is the Bulls, Bears, and the Bell Market Wrap. And if you sent us your research notes today, thank you, because this session was, let's just say it was brutal to synthesize.
It really was. We looked through that whole stack, your notes, the trading logs, all the data, and the one clear takeaway is that this was not a day driven by one simple macro story.
Not at all. If you felt whipsawed today, you were reading the market correctly. We're calling this a day of, well, intense and significant divergence. We watched the market being driven almost entirely by this aggressive intra-market rotation, just money flying between sectors rather than any, unified theme.
And that really sets up our mission for this deep dive. We have to unpack those conflicting signals. Because on one hand, you had this really aggressive technical defense of key levels.
Right.
But that was happening against this harsh reality of soft economic data and, frankly, the signs of fading AI momentum.
So understanding this rotation isn't just an exercise.
No, it's absolutely key to navigating the serious concentration risk that is still baked into these major indices.
Okay, so let's unpack this. Where did the fear really start this morning?
It began with the economic calendar. Specifically, that really disappointing Philadelphia Fed index reading.
That miss felt significant right away.
It was, because it immediately backed up this whole narrative of a slowing manufacturing sector. You have to remember, the Philly Fed is one of those early red indicators for industrial health.
So a surprise drop like that is a big red flag.
A huge red flag for the broader economy.
And which parts of the market felt that pain first?
Oh, the cyclicals and value plays. The stocks that are most tied to, the physical economy expanding.
Heavy industry, some financials.
Exactly. And that risk-off signal pushed the DJIA down about 176 points right at the open. It confirmed that this fundamental economic fear was active.
Okay, so we've got fundamental fear hitting cyclicals, but then the story it pivoted. It shifted from that macro fear to tactical profit-taking in the big leaders.
You did.
So why? Why did the selling in big tech suddenly outweigh that fundamental fear? Are traders just ignoring the economy now?
They're not ignoring it, they're reacting to positioning. We finally saw the fading momentum of the NVIDIA-led rally catch up to itself.
So was exhaustion?
It was exhaustion. When the macro picture gets shaky, what do traders do? They look for the most crowded, high-flying trade, and they take profits. That's been AI. That's been semiconductors.
So it was positioning driving the bus, not just the Philly Fed.
Absolutely.
And just when things couldn't get any more volatile, we get the delayed September establishment survey data late in the day.
And that jobs data, that was the 1-2 punch that just completely overwhelmed any of the technical defense we saw earlier.
What did it show?
It showed the labor market is still stubbornly tight. 119,000 jobs added, and even though unemployment ticked up a bit to 4.4%, the takeaway was clear.
Good news is bad news.
The classic good news is bad news reaction.
Why does a strong jobs number cause such a sharp sell-off? Break that down for us.
Because the market reads it as a green light for the Federal Reserve to stick to its aggressive, higher-for-longer rate policy.
No reason to pause.
No reason at all. Strong hiring fuels inflation worries, which means the Fed has no excuse to signal any kind of easing. And for traders, higher rates are just kryptonite for growth stocks.
And the sell-off that followed was brutal. The Nasdaq composite got hit the worst. It closed down a full 2.2%.
Yeah.
The S&P 500 dropped 1.6%, and the Dow finished down 0.8%. But that huge underperformance in the Nasdaq, that tells the whole story, right?
It really does. It's all about that acute pain in the long-duration, rate-sensitive tech sector. But now we have to step back a bit and connect this domestic rate fear to a bigger global concern that's popping up in our sources, and that is fiscal sustainability risk.
Okay, so this isn't just about the Fed anymore.
No, it's bigger than that.
Explain that link. How does a tight U.S. labor market tie into global bond yields and this idea of fiscal risk?
It's a chain reaction. A tight U.S. labor market forces the Fed to keep rates high here.
Yeah.
And when U.S. Treasury yields rise, they're the benchmark for borrowing costs everywhere, so that pushes up global bond yields. But the real fear behind fiscal sustainability risk is the massive U.S. deficit and debt.
The cost to service that debt.
Exactly. Rising debt plus rising rates means the cost of servicing that debt starts to look unsustainable. And investors are now officially starting to price that risk in.
So what does that do to stocks?
It raises the overall equity risk premium. That's the extra return you demand to own a risky stock instead of a safe bond. And it is just hammering stocks with lower quality, far-off cash flows.
Which are the high-growth tech darling.
Precisely. This whole backdrop is just cranking up volatility across the board.
That sets up the core conflict of the day perfectly. Because despite that terrifying macro picture, the market internals were telling a completely different story.
Totally different story. It was a battle between fear and conviction.
Let's start with the fear. The VIX.
Yeah, the VIX, the market's fear gauge, is still highly elevated. It's at 24.69. That is a major signal.
So what does a VIX in year 25 tell an active trader? What's the move?
The move is be careful. It's signaling sustained downside risk, real anxiety. It's a clear warning from the options market. It's basically saying sell the rally, or at least hedge aggressively. It says don't trust the bounce.
Okay, but this is where it gets so interesting. Contradicting that fear, we had these extreme short-term bullish signals from market breadth. Let's start with the NYSE tick. The tick, it peaked at plus 1,100.
A tick reading over 1,000 is incredibly rare. You have to think of the tick as the moment-by-moment pulse of institutional money.
So this isn't retail traders.
No. When it hits plus 1,100, it means for that brief moment, 1,100 more stocks were trading on an uptick than a downtick. It's a massive, coordinated liquidity injection.
It's the big desks.
The big desk saying, we are buying this dip right now together.
And the TRIN, or the ARMS index, backed that up.
It did. With a reading of 0.55. And a TRIN, reading that low, well below 0.70, confirms that the buying was aggressive and super concentrated in the stocks that were already advancing. It wasn't random. It was definitive.
So you have the VIX screaming, protect your capital, and the tick and TRIN screaming, massive coordinated buying. How do you make sense of that? What kind of rally is this?
It's a liquidity-driven rally. That's the professional interpretation. You have to ask why institutions are buying into such fundamental weakness.
Right.
And the answer is they're stepping in to defend the short-term uptrend. This is protective buying, trying to keep the market above critical technical support levels after a few bad days.
So the recovery is purely technical. It's not based on any conviction about the economy or rates.
Exactly. The high VIX tells you it's a defensive move. And for you, that means you have to stay vigilant. You have to watch if these breadth indicators hold. Because if they don't, that liquidity support can vanish in an instant.
And that conflict led directly to the sector rotation we saw. I mean, a clear flight away from high-growth tech and into defensives.
Today's mandate was all about preservation. That high VIX forced portfolio managers to de-risk, and they ran straight for the classic defensive plays.
Like utilities, XLU.
Utilities are the textbook move. Low beta, recession-resistant. They provide essential services, stable dividends. It's where you hide when fear spikes.
And we also saw healthcare, XLV, act as a safe haven.
Yep, it's less sensitive to macro swings. Capital has to go somewhere. And XLV offers protection from economic jips.
Okay, now for the source of the selling. The laggards. It was most severe in technology, XLK, specifically semis and the AI names.
Yeah, that AI bubble narrative is really taking hold on institutional desks. They're starting to realize those extreme valuations require perfect execution in a world where rates are rising.
We saw that in the sources, the pressure on NVIDIA, for instance.
Exactly. Our sources pointed out that NVIDIA stock was already down 7.9% in November, even before today's big sell-off. That's not a one-day blip, that's a structural profit-taking move.
And discretionary XLY also got hit, which seems tied to those consumer fears.
It is. A high VIX, plus an uncertain global outlook. We saw slowing UK GDP data spooking people too. It just makes high-end discretionary stocks very unattractive right now.
So what is the actionable takeaway from this wild sector shuffle?
You have to treat this as a high volatility technical rebound. The market showed short-term conviction with that breath. But the rotation into defensive says the rally has no fundamental legs.
So stick with the momentum in defensives.
Exactly. Focus your trades in utilities and healthcare. And if you do dip your toe into growth, you have to use extremely tight stop losses. The floor can drop out fast.
Now let's look past the close because the after-hours session gave us some critical clues. We saw a pretty significant technical bounce in some of the most beaten-down tech names.
This action is so important for setting tomorrow's sentiment. We saw big after-hours moves in names like Micron, MU, up 4.25%.
Right, and Arista Networks, ANET, up 4.02%, and Palantir, PLTR, up 3.98%.
These are the exact names that got crushed today. Seeing them bounce so hard, likely on short covering, sets a very interesting indicator for the morning.
We also have a key corporate event overnight. The Webull Corporation, BULL, Q3 2025 earnings.
That's the big one. That report is going to move the whole fintech sector.
And the options market was expecting a big move.
A huge move. The implied volatility was pricing in a potential plus or minus 12.0% swing on the news. The reaction to that report will set the tone for all financial tech stocks going into Friday.
All right, let's set the stage for Friday. What are the critical points of focus for the open?
First, it's all about technical levels. You have to watch the S&P 500 futures, the ES, and see if they can hold today's low-end range. If that after-hours tech rally fades, we could be looking at a serious retest of support.
And with no major data on the calendar, the focus shifts.
It shifts entirely to the Fed. We have to monitor any scheduled or unscheduled Federal Reserve speaker commentary. Any new clarification on that jobs data could completely erase this technical bounce.
Okay, finally, the primary actionable trade for the open, assuming that after-hours strength holds.
You watch the major tech ETFs like XLK. If those gains in Micron, Arista, and Palantir hold up or even expand in the pre-market, then a powerful short-covering move at the open is your primary directional trade to watch.
That was a deep dive into an incredibly complex day. So the critical message for you listening is this. The market is actively challenging its own leadership structure.
Right. It's rotating out of mega caps and into defensives.
But,
and this is the crucial part, that extreme intraday breadth suggests the underlying uptrend is still being defended by institutions with massive amounts of liquidity. It's technical protection versus fundamental fear.
okay, here's a final thought to chew on as you prep for tomorrow. If the Nasdaq fails to hold these strong after-hours gains into Friday's open, then today's action wasn't just a technical blip that institutions fixed. It was a structural sign of mega-cap exhaustion, and it could be preparing the market for a much deeper correction.
Something that demands very tight risk management heading into the weekend.
That's a wrap. Thanks for joining us for this deep dive on the bulls, bears, and the bell market wrap. We'll see you at the open.